All right, well, welcome everyone. Welcome to our session. I'd like to introduce our speaker today, Michael Lamb. Michael's a founding partner of Corporate Advisory Solutions, which is a merchant bank with offices in Philadelphia and Washington, D.C. that supports a select group of clients. As managing partner at CAS, Michael oversees and executes on M&A engagements, investment opportunities, compliance and regulatory assessments, valuation, and expert witness litigation matters, while also charting the firm's corporate direction and strategic growth plan. With that, I will let Michael take it away.
Thanks so much, Casey. It's great to be speaking again to the PACE membership. It's been quite a wild year over the past few months with the pandemic and everything else that's been going on. But one of the topics that the PACE folks had asked me to speak about today was around the M&A activity and just the current landscape of the contact center industry and how everything's been, what's been happening from an M&A perspective in the midst of this pandemic. And I wanted to run through a few things today, just kind of that are been top of mind for our deal team and things that we're seeing in the market that I think will be useful for all the folks attending the industry conference over the next couple of days. And as I go through my slides, if there are questions, feel free to ask them into the chat box, or if at the end of the session, if you have specific questions, I'll make sure that you have my contact information and you could call or email me directly. But again, I'm hoping that we'll have some time toward the end where I could answer any specific questions that any of the participants have. So just to kind of kick things off, this is just our standard disclaimer, nothing really to go through there. One just quick note on my background. So our firm focuses in the tech-enabled outsourced business services area from an M&A and valuation perspective. We have three primary coverage markets that we do most, if not all, of our deal activity in. The first is the contact center or call center area. And we also do work in healthcare revenue cycle management, as well as the accounts receivable management area, or better known as the debt collection industry. In terms of our topics today, I want to talk about kind of just an overview on the size and scale of the contact center industry, talk about how COVID's affecting the market, some of the key value drivers and detractors that are affecting value for companies in this market. And then I want to talk a little bit about the multiples and how companies today are being valued in the market. And then I'm going to summarize some of the key things and kind of hot button issues we're seeing around COVID and what that's doing to transactions today. And then again, as I'd mentioned earlier, happy to answer any questions that anyone has. So in terms of the industry size, just to jump right in, you're looking at an industry size of about 24 to 25 billion of overall revenue that's coming out of just traditional telemarketing and call center lines of business. And as you can see, this data is as of 2019. The 2020 data is obviously not come out yet. But one of the major shifts that we've been seeing happening even before COVID was just around the mix of business. Customer care, the whole telemarketing outbound world is shifting a lot to digital and omni-channel, which we're going to talk about later. And it's really changing frankly, the entire landscape of the market. We're rarely calling the call center industry the call center industry. It's much more than that today. And so as a result of that, we're seeing a lot of shifts in the market with technology and how services are being delivered to different end markets, whether it's a consumer or a business. As it relates to COVID and just the overall industry, it's certainly been a mixed bag. There have been certain industries that have been booming as it relates to COVID, specifically everything from food delivery companies, any kind of home repair or distribution type function that is going directly to a consumer from a delivery perspective has been just growing dramatically. Everybody's, I'm sure, seen the growth of Amazon over the past few months. They've been growing even more so. And as it relates to just the delivery side of service lines, we are seeing, because more and more people are at home, just around how people are communicating from an omni-channel perspective. Phone calling efforts are shifting pretty quickly into email, text, and chat functions to deal with everything from food delivery to home repair to IT and technical support issues. Now, one of the key areas that we do see that hit this industry pretty hard was when COVID hit, and the shift to work at home was certainly challenging for many countries, specifically like the Philippines and India. We saw massive centers shut down for a period of time as they were getting work at home established, and from a technology perspective, being set up in a manner that was going to be able to be used and be able to be consumers and businesses were able to communicate effectively with those work at home agents. But surprisingly, these companies across the PACE membership reacted very quickly and were able to establish work at home and hybrid business models very quickly. And it was amazing to see how companies in the space were able to shift and get everything in place from a internet bandwidth perspective, technology, data security. We saw companies moving at light speed within 48 to 72 hours were fully operational, either through a work at home model, or if they were operating and allowed to, offshore or nearshore. So we were quite impressed with how the companies reacted. Now, one of the issues now is, as companies have begun to move into more of a hybrid business model, a lot of the companies have gotten more comfortable with the work at home model, and that's certainly been an issue for bringing people back into bricks and mortar centers. So we've been seeing that as a issue that folks are trying to work through and get comfortable with as folks begin to head back into the bricks and mortar sites again. In terms of the M&A activity, as expected, we saw a big drop-off in Q2 in transaction activity, but Q1 was active, but we did see a drop-off in Q2, specifically because of COVID, as you could expect. In our world, in our company, we saw, I would say, 85 to 90% of our transactions in the month of March went on hold due to COVID. So we obviously are not the only firm out there doing transaction work across these different industries, but we heard that from many of our other peers too, that as the transactions and as things were unfolding from March through May, many transactions went on hold due to COVID. But What we've now seen, since things have kind of within our new normal, we've seen the market change, and there's been a significant pickup in M&A activity across not only the contact center industry ecosystem, but across a lot of other business services, tech-enabled services industries. So it's great to see that deals are beginning to slowly bounce back. In terms of some noteworthy transactions, there were several deals in the contact center ecosystem that occurred. I have them up on the screen here on page 4, but these are just a few of the publicly announced transactions that occurred in Q1 and also into Q2 as well. Some of these specifically were more technology oriented, as well as, like as an example with the Advantage deal, it was very much focused on the Spanish speaking market or Latin American market, as well as for the 24/7 InTouch deal. So there's certainly been deal activity. So one of the things I wanted to make sure everyone hears loud and clear is there are deals getting done in the market, and their deals are changing and they're different, but they are getting done. And I'm going to talk a little bit about in the next few slides how those deals are getting done and why they're getting done, and how COVID is affecting those transactions as well from a quantitative perspective. In terms of value drivers and detractors, not much has changed with COVID, but one of the key things that buyers, both strategic as well as private equity buyers, are always looking for is obviously a client base that has low levels of client concentration. I can't tell you how many times we see companies that have concentration with a large financial institution, a telco, a large utility, where it represents 40 to 60 or more % of the overall revenue. Know that even with a multi-year contract, and with that kind of a concentration risk, there's going to be deal structure, earnouts, retained equity, a seller's note. It's going to be factored into the transaction. But one thing to note, though, a lot of folks that reach out to us as sellers sometimes get concerned whether there is even a market for companies with that level of client concentration. I want to make it clear that there absolutely are buyers out there for deals that have client concentration in our market. It just ultimately leads to structure. So deals do get done with high levels of concentration. It just likely leads to more deal structure as a result of it. Some of the other value drivers for companies in our space are around technology, infrastructure, making sure that there aren't any legal or regulatory issues in place. And by far, one of the key drivers, especially for private equity, when they're making any type of investment into our market, is making sure that there is a seasoned executive team, management team that would be sticking around post-transaction. These businesses, as much as folks would like, don't run by themselves. They need people at the helm, and private equity values that. And having a team in place that has been around the field, has been through multiple market shifts or recessions or changes, is a major reason why deals get done in the marketplace. Another key driver for value in this industry is around financial performance. When companies see, or a private equity or strategic sees up and down roller coaster financial performance, buyers tend to get very concerned about the sustainability of revenue and EBITDA, even in a pandemic. So know that that's going to be a key driver for overall value. To talk about value detractors, we talked about client concentration as being a top of mind one, but I will tell you, even with the market changes and when site visits come up, whether they're virtual or on site, making sure that you have up-to-date technology, you have operations that are clean, efficient, and are ready to go from a work at home perspective in terms of being able to shift quickly or pivot into a work at home strategy, whether that's your core business or not, is certainly going to be looked upon as a major driver in value. And if it doesn't exist, it's going to hurt you out there in the market, especially after seeing what has happened because of COVID. I'm just going to keep running through here. So this is kind of the big chart that I know everybody gets focused in on. This is by, please keep this as a, and I'll just disclaim it, this is just a guidepost for folks or guardrails. This is not the end all be all. There may be companies that are very special that fall between 5 and 10 million of revenue that would trade differently or trade for higher multiples or in fact lower multiples. This is coming out of our proprietary done deal database of transaction activity that we track in these different industries. And so again, we're seeing different multiples for smaller companies than we do larger companies. But if you look at this chart compared to where things were this time last year, you would not see much of a change in multiples. What you are seeing is that the businesses that are selling in today's environment, there's something either unique about them or there's something that's driving their financial growth and performance that is putting them in a position where their numbers are attracting both strategic as well as private equity buyers to the table. And those deals tend to be larger in scale and are attracting these higher multiples in the marketplace. So if you have, and again, we're giving this to you as revenues, but think about it from an EBITDA or earnings before interest, taxes, depreciation, and amortization perspective. If you have 3 million plus of EBITDA on a recurring basis, you're likely going to be able to attract not only a strategic or an industry buyer to the table, but you will also be able to attract a private equity firm, a family office, or even a high net worth individual, because at that size of EBITDA, you kind of hit the map. If you're smaller than that, you tend to only be available to a strategic or an industry buyer that's looking to bolt you on or consolidate the business. Now, one of the other things that we're going to talk about in a minute is around COVID and how that's being factored in. Those expenses are being factored into adjusted EBITDA, and we're going to talk about that in a minute as well. So in terms of the COVID effect, there is no doubt there has been a large effect on just overall performance. Now, depending on the market that you're in, it's as I said earlier, it's been a mixed bag, but there is plenty of capital. There's actually a surplus of capital within private equity and not enough good deals to fit for them to deploy it. So there is plenty of capital, but there's got to be also good companies for them to invest into. And so more and more, because of the omni-channel shift that's going on across the market, as well as work at home, these companies are becoming more and more attractive to financial buyers. And we're anticipating that to continue throughout this year and into next year. So we're really excited about that. Now, the question around value and what value is doing to businesses today is around COVID. And so our question that we're getting most from buyers and sellers in the marketplace is, how is COVID being incorporated into adjusted EBITDA? And what I will tell you is that they are looking at it very significantly, because they're trying to determine if there needs to be any adjustments. So if there were expenses related to work at home or other costs to set up to be at work at home, those expenses are being added back. Things around, changes to your expense structure to move to work at home, those are items that are being addressed and being factored into how companies are being valued in the marketplace. Some companies are seeing such a growth in revenue right now. The buyers are questioning whether, when the market gets back to sustainability, or when we're back to some new normal, what that's going to do to the revenue of businesses in the market. And they're being, those revenues in some cases are being discounted, or any project-oriented revenue are being pulled out of the valuation calculation completely. So there's a lot of financial analysis that we are doing and others are doing in order to understand the word sustainability of revenue and EBITDA going forward. But as it relates to this presentation, and I know we're trying to get through a lot of information quickly, just know that there will be adjustments for COVID incorporated into the valuation if and when you're considering a sale of the business. So in terms of just the overall pandemic, and how we're seeing the environment shift, obviously work at home and remote work is certainly not going anywhere. I wrote about it in 2006, and people said, Michael, the call center industry is bricks and mortar. Doing things work at home is going to be so difficult. Well, I think we all have seen that logic thrown out the window. It's not going anywhere, and it's going to be a part of business models going forward. And I don't see anything shifting there. I do think it's going to spur more strategic buyers and financial buyers to come to the table and look at companies in the market. Now, that doesn't go without risk, though. I think we've got some major issues on the horizon related to data security, both onshore and offshore. And I think that that is going to be the next big horizon for the industry to make sure, or to mitigate any major data security breaches across every vertical market that this industry touches. And I do think that we're going to see even more technology advancements around AI, machine learning, whatever buzzword you want to use, is going to create even more margin enhancement and efficiency when it comes to this business. So overall, we're very bullish about the growth and the scale of this industry. We think that there's a lot of opportunities ahead of us, and we're fully expecting that there's going to be a lot more M&A activity on the horizon. So we're very jazzed about that. As I had mentioned at the earlier part of the presentation, on the screen here is my office number and email address, but you could also find us at our company website, as well as on LinkedIn. Casey, I know I just ran through a lot here very quickly. I'm not sure if there's any questions that came through the chat bot, but happy to answer them, or and stay on and open it up for Q&A.
Sure. We do have a few questions, people wondering if we can provide this deck to them.
Absolutely. Yeah,
Okay.
that's not an issue at all. Happy to do that.
Okay, great. Well, I have the list of people here, and I do have the copy of this, so I'll be happy to send that out when it's finished.
Right.
Let's see. So if anyone has any other questions, we can, oh, here we go. From Gary Puddles, have you seen any discussion of rising wages in the industry?
Oh, great question, Gary. I mean, we've seen in certain markets that have different minimum wage requirements that's shifting. And we've also seen as a result of that, of labor wage changes, folks are going into other second tier, third tier cities in other particular states to try to combat those issues. And especially where even work at home or work at home is not as, you're not seeing those requirements. So we're seeing a lot of companies setting up operations in the Midwest, the Southwest, and certain parts of the Northwest corridor as well. Well, look, if there's no other follow-up questions,
Oh, wait,
go ahead.
got one more, got one more.
Okay. Okay.
What does the third quarter look like?
Third quarter, the election from an M&A perspective is throwing a lot of wrenches in a lot of discussions with potential buyers and into the end of the year. So we're seeing a lot of deals. We have a lot of deals in market right now, but our biggest challenge is what will this election hold? Whether it's Biden, whether it's Trump, and then ultimately with capital gains. There are a lot of deals that are trying to get done by the end of the year. But I will tell you, the election will certainly be a variable in whether those deals close or get delayed into next year, in the first quarter of next year. And one other point there, Casey, is just the economy overall. I think we have another challenge in front of us, being that the next round of stimulus was put on hold. We've got that to contend with. So if you have clients or if you're in markets that are relying on that additional consumer savings or value that they were getting out of stimulus to use for them to be buying products or services, I've got some real concerns in the back half of this year without any additional stimulus, what that may do to the to consumer confidence, but also just the overall purchasing of every kind of product you could think of, and what that's going to do to the market. And there may be a further slowdown as a result of that.
Are the deals bigger or smaller than the ones that you're seeing now?
We are certainly seeing bigger transactions as we get closer to the end of the year.
And what about the PPP loans? How are those being dealt with?
Great question. PPP loans, if a private equity firm is looking to buy into the industry, or frankly any industry, they want that PPP loan to be off the balance sheet or forgiven, however the process is going to be. So they are not, we're not seeing anyone taking over that liability or assuming it. They are stripping it out and requiring the seller to deal with that as a part of either prior or at closing. They don't want to take on the liability politically, especially for private equity. They don't want to have the view that they're taking the government funds.
All right. I don't see any other questions yet. Well, and as we might have mentioned, but if not, this recording will be available on the website in just a few days. And then, like I said, I'll get the slides out to the people who are interested. But if you do have any questions for Michael, please feel free to contact him.
Very good.
All
Well, again, thank you to Pace and Casey. Thank you again for having me today. It's a
Absolutely.
pleasure.
Well, thank you for being here. We appreciate your time. All right. Thanks, everyone. Have a good afternoon.